pretty wild.
And I think also like it's important to understand that the practice of market making, I mean, this practice dates back hundreds of years. You know, if you were to look at the exchange floor, you know, initially speaking, it was made up of market makers and brokers quoting, you know, bid offer spreads in real time. You know, compare and contrast that with the B-book model. Again, these market makers, like Angus said, they're the most technologically savvy. They have the best quantitative analysis. You know, they themselves understand their own limitations in the sense that their predictions can go as far as minutes and seconds, but definitely not, you know, beyond that. And these are the best in the world, filling everything sub 1 millisecond in the best of cases. And also they all know they're sitting in a liquidity pool competing for client flow. So ultimately they have a very big incentive to offer the best, you know, the best pricing, the tightest spreads, so on and so forth, because again, it's a hyper competitive industry. When you compare and contrast that with the liquidity you'll see on a B-book, you know, which as Angus said is almost like a snapshot from a third party liquidity, you know, how can you expect to be offered, you know, the best spreads, the tightest, most competitive pricing, when in essence there's no incentive for a B-book broker who's ultimately pricing themselves into their own, you know, book, if you will. What incentive do they have to give you such tight prices? Can be in contrast with the market maker who is competing for flow.
It's interesting, you know, we talk about market makers, and the question that you brought up earlier that some clients have brought up through this series is, how do I know that the market maker on the end of my trades is not a B-book? So we've made the distinction that a B-book is when you're profiling losing clients into a separate book. The market maker can't do that. When a market maker or a non-bank market maker is priced into our stack, they're not actually seeing where our clients are positioned, and they're not separating clients into an A or B book, so they can't actually be a B book. Instead, what they do is they just price the best. I mean, even it's amazing to see how much flow over the last 5 years, say that non-bank market makers have come in, and now they take the vast majority of the flow, whereas back in the day, it would be more tier one banks that were taking it. So as you were saying, they've really helped to make a more efficient market for people. And, you know, a lot of our trades that are filled with these non-bank market makers are actually done in 1 milliseconds or sub 1 millisecond latency with these guys. So yeah, it's interesting that we kind of have the best of both worlds in our setup.
It's like we touched on in the liquidity episode that we did, you know, a few months back, that from a market maker standpoint, they're happy to see, you know, winning clients as long as they're seeing balanced flow, as long as they're seeing all of the flow. From a market maker standpoint, they have no issue with that. So, you know, again, because the intention is not to profit from client losses, and that's the big distinction in my mind that needs to be made very clear.